Ladies and gentlemen, good day and welcome to the Khadim India Limited Q3 and 9 months FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Omkar Bagwe from MUFG in time. Thank you, and over to you, sir.
Yeah, thank you. Good evening, everyone, and welcome to Q3 and 9 months FY26 earnings conference call of Khadim India Limited. To discuss the results, we have with us from the management, Mr. Ritwik Roy Burman, the Managing Director, and Mr. Indrajit Chaudhary, the Group CFO. They will take you through the results and business performance, after which we can begin the question and answer session. Before we begin the conference, I would like to mention that this conference contains certain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. The actual results may differ materially. These statements are not guarantee of the future performance of the company and involve risks and uncertainties that are difficult to predict. I now hand the conference over to Mr. Ritwik. Thank you, and over to you, sir.
Yeah, thank you. Good evening, everyone. On behalf of Khadim India Limited, I welcome you all to today's conference call to discuss our Q3 and 9-month FY26 results. We appreciate your continued engagement with the company and trust you have reviewed the financial results and investor presentation submitted to the stock exchanges. The third quarter of FY26 was marked by a relatively subdued demand environment, particularly in value-driven segments, amid continued pressure on discretionary spending. While urban markets demonstrated pockets of resilience during the festive period, overall consumption trends remained measured. In this backdrop, we stayed focused on disciplined execution, prudent inventory management, and calibrated marketing initiatives to protect margins and sustain brand visibility. Our partnership with Skechers continues to progress positively during the quarter. Skechers recorded a sequential doubling of sales, reflecting strong consumer acceptance and improved throughput across pilot locations. This reinforces our strategy of strengthening presence in the premium and lifestyle footwear segments while maintaining balance within our portfolio. The athleisure portfolio continues to witness steady consumer interest, and we are selectively expanding distribution based on store-level performance metrics. Among our sub-brands, British Walkers delivered a healthy year-on-year growth of 9.9%, led by consistent traction in the men's formal and semi-formal categories. Sharon maintained stable performance with continued emphasis on refreshed designs and improved in-store merchandising. We are also intensifying localized marketing efforts and enhancing visual merchandising standards to drive higher conversion. Operationally, we remain focused on optimizing costs and improving working capital and efficiencies. Inventory was closely aligned to demand patterns to mitigate markdown risk, particularly during the extended festive cycle. Franchise engagement remains strong. We continue to work collaboratively to drive throughput and profitability at the store level. Let me now take you through the financial performance for the quarter and the 9 months ended 31st December 2025. For Q3 FY26, revenue from operations stood at 86.2 crore, registering a decline of 21.8% year-on-year. EBITDA was 11.1 crore, down by 31% with an EBITDA margin of 12.8%. We registered a minor loss of INR 0.2 crore during the quarter. For the 9-month FY26, revenue from operations stood at 283.5 crore, reflecting a decline of 12.5% year-on-year. EBITDA was 37.2 crore, down by 24.5% with an EBITDA margin of 13.1%. The decline in PAT during the period was primarily attributed to the impact of the revised labor code implementation and changes in recent government norms, which resulted in higher employee-related costs and compliance adjustments. As of the end of the quarter, our retail footprint stood at 864 stores, comprising 195 company-owned outlets and 669 franchise-operated outlets. E-commerce sales continue to contribute steadily, and we remain committed to building a balanced omni-channel presence. Looking ahead, we remain cautiously optimistic. Our priorities remain unchanged, driving profitable growth through sharper product curation, disciplined cost management, brand investment, and continued expansion in high-potential segments. We believe our diversified portfolio, strong distribution network, and focused execution will position us well as demand conditions gradually improve. I conclude my remarks and would be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Rutuja from MKSD Advisor. Please proceed.
Hello.
Hello.
Hello. Yeah, am I audible?
Yes.
Thank you for the opportunity. You indicated.
Ma'am, can you please be a little louder? We can't hear you.
You are not audible.
Hello.
Hello?
Am I audible now?
Yes, now you are.
Yeah.
Okay. So, sir, you indicated double-digit growth in premium sub-brands. So, what percentage of total retail revenue do these now contribute?
Sub-brands.
Yes.
Sub-brand would be about 60%, and 40% is the mother brand Khadim's.
Okay. And what is the margin differential versus Khadim's mother brand? Can the premium become like 20-25% of the mix in the next 4 years?
No, means the margin is slightly higher in sub-brands, 2 to 3%. But what Ritik has mentioned here, that the growth in British Worker. Out of the sub-brand, there is a growth in the British Worker, which is a premium leather men's formal shoes. So there we have seen growth, and also in Sharon.
Sharon also we have seen growth.
Which is around 10 to 15% of the total sales of the company.
Okay. So, like, can this be like 20-25% of the mix in next 3 to 4 years?
Yes, we are focusing on the premium brands, and we are giving it to the location, means retail. So in order to increase these two premium brands, more products have been this year. New products are also being built on these two sub brands. Hopefully, by as you call 3 to 4 years, these two will contribute around 20 to 25%.
Okay, sir. And one last question on the Skechers partnership. Can you please help us understand the revenue contribution so far and the store rollout plan?
It's a very pilot project we have done this year. So it's around 1.5 to 2 crores. But hopefully in next year we will increase, and now I think it's around 20 stores.
Yeah, right now we are giving it to only 20 stores. So before we were giving it to 10 stores, now we have increased it to 20 stores, and around 1 to 2 crores of turnover is coming from it. So we are meeting the Skechers team. We have gone for their displays and everything. So gradually we'll increase the range as we deem it fit.
Okay, sir. That's all. Thank you. Thank you so much for the answers. Thank you.
Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question is from the line of Riya Malik from RMK Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes, Riya, please proceed.
Yeah. Sir, thank you for the opportunity. I meant to ask that the revenue declined 21.8% year-on-year in Q3 and 12.5% in 9 months, while the gross margins are also compressed. Can you break quarter three performance into volume decline versus price declines versus store closures impact?
See, what I can say about the decline is, I also mentioned in my opening speech that we are doing we are trying to make our working capital in a better situation. So especially in this quarter three, what we did is we did skewed inventory purchase. Like we didn't purchase so much of inventory. So maybe because of that, some amount of sale would have got affected. Because this year the Puja festival got over in September 30th itself. So after that, October, November, December, we wanted to have a healthy inventory situation and even our creditors' days situation, because the market is also a bit subdued. So we curtailed our purchase. So because of which there was, you can say, some amount of the reduction in sales is because of that. Reduced inventory purchase, and apart from that we also closed lot of unprofitable stores in the past 2 years. So because of that reason also some of our declined. So it's a culmination of both these two things.
Around 7 to 8% decline is because of the store closure. Okay. And also here, as Ritik pointed out, the creditors' days has come down from 131 days in September 2025 to 117 days. So we are, by March end, we will again reduce the working capital, means credit inventory days. So we have consciously done this, but however, from the next year, then after reduction of inventory, we will now fill up with the inventory that are moving, and hope that means the sales reduction because of inventory will not be in the next quarters. However, there is a challenging situation in the market also, so we are taking other avenues like the e-commerce from where to generate more revenue.
Okay, sir. Okay, got it, sir. And so, what would be the underlying like-for-like volume growth, excluding closed COCO stores?
Volume growth means it is a 2% degrowth is there now in volume.
Volume, like last year, there used to be a huge volume degrowth. But now it's 2%.
Compared to like-to-like stores.
Like-to-like stores. And if you take closed stores, then it would be higher. But that's the thing.
Okay, sir. And okay. And so now that the GST reduction has been fully operational for a quarter, what has been the elasticity response in the 500 to 1500 segment?
Not much impact has come because this quarter is not a major, because we have taken already, you have seen the sales degrowth. We have taken hit in the inventory. So I think in the first quarter because this quarter also, in the fourth quarter also, there would be inventories less compared to the last year. So the full, we can see the GST impact in the first quarter of FY27. Means the GST impact is there, the margin has improved, but the volume is not yet coming.
Okay, sir, got it. And sir, last question. So, are you seeing any recovery in the ticket size or in only footfalls? Like, are you seeing recovery in ticket size or only footfalls? And also, is secondary growth stronger than the primary billing currently?
No, see, our retail is a secondary sale. So whatever we are seeing degrowth in retail, we are also seeing the degrowth in our franchisee stores, for which our primary is also reduced. So there is a degrowth in footfall, but hope means that we cannot stop because its impact is in total market. But whatever we are doing is we are trying to increase the UPT and also try to not to degrow in volume. So these two steps we are taking, but we are more aggressive in our e-commerce business because that is generating means growth more than what we are expecting. However, in this offline channel, we will open new franchisee and some new COCO in strategic location. These two will be the growth factor for the next year.
Okay. Okay, sir. Got it. Thank you, sir. Thank you so much.
Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one. The next question is from the line of Anupam Jain from Indra Securities. Please proceed.
Sir, your other income was higher this quarter. Can you please explain?
There is since we have closed some shops in this quarter, so this is mainly because of the impact of the liability written off for the Indes thing. So for that reason, it has increased.
Okay, so this won't be the sustainable number going forward. Okay.
No, that's one-off numbers.
Okay. Second is how you had a GST input tax credit of somewhere around 23 crores in FY25, ending FY25. What is your number? Have you used that credit?
During from April to September, the credit has been utilized. Now it will be around 13-14 crores lying in our input tax credit.
13-14 crores still left till now, 9 months.
But since now the GST has reduced, so utilization will be less compared to what it was previous.
So what will the time period?
If you have stock of 100 crores, then it will be, because that stock is GST paid stock. So the GST input will remain there. Because your input will only go down if you have stock layer, zero stock, then your input will be less. But as when you purchase, the input is high. And since in the last quarter our purchase is less, so our input utilization was higher.
Okay, purchase was less, the input utilization was higher.
Because when you purchase, the input GST accumulate in your GST ledger. So if you reduce the purchase, then the input accumulation is lower and your output utilization is higher.
Output utilization, okay. So when can we expect this to be set off? This whole amount will be utilized, because this will directly actually why I'm asking is this will directly help in our working capital cycle.
But this will not set off completely, because you will have stock. You will have 90 to 100 crore stock in your company. So that stock we have to pay the GST and bring the stock. Everywhere it's a GST paid stock. So input credit will remain. Until every stock is cleared, it will remain.
Okay, and then what is the amount that sustainably that will be in ITC rate that will be stuck in there?
Around 12 to 13 crores, because it was when the GST was implemented, it was there that GST will because previously in the VAT regime for stock transfer you don't have to pay GST, but now for stock transfer you have to pay GST. So GST, wherever there is a stock lying, there will be a GST input lying there. This is the logic of GST.
Okay. And in Punjab government, what is the case update? Any update on that?
It's pending in the High Court, and there are 2-3 dates already. We have our hearing done. Maybe within next 2 to 3 months, some hearing output will come.
Okay. So your margins have declined because in the last 9 months you have guided that you want volume growth. Not sort of volume growth has come, but your margins have declined. Can we see this increasing in FY27?
Already in third quarter, the margin has improved. Again, in the next year, with the premium product being the percentage is higher, the margin will definitely improve.
Okay. Any guidance that you want to give?
Right now, means we are fixing the new margin for our new product. I think by the end of this quarter, we can guide a picture for the next financial year.
Your new product is?
For the SS26 and AW26.
That's it? Sorry, I didn't get it.
This is the new product that we create for our spring-summer season and for our puja.
Okay. And what will be your debt guidance? Because as you're looking to cut down your working capital, will this also be reduced? Your debt will also be reduced this year?
This year, debt will be remain because we have reduced the stock. So again, some stock we require. So it will be more or less in the 110 crore range. Whatever we have in December, around 114, we will be having 110 crore debt.
Okay, so it will be almost flat to a slight growth. Okay. Okay, that's it from my side. Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. The next question is from the line of Viral Jain from SMG. Please proceed.
Yeah, hi. Am I audible?
Yes.
Yes, sir.
Yeah, thank you for the opportunity. I have got a couple of questions. So my first question was with regards to the inventory. So just wanted to know, has the inventory cleanup largely concluded?
The inventory, we have reduced the inventory, as I told, from inventory days of 131, it has come down to 117 days now. And by next quarter, we will be landing up around 105 to 107 days. But after that, when we are cleaning up inventory, we are also have to build some inventory for the new product. So that will be there, but we will be ranging within these days in inventory levels.
Got it, sir. And my next question was with regards to the sale. So what percentage of sale in Q3 came from the promotional discounting?
Around 20 to 22% in our cocoa.
Okay, 20 to 22%. Got it. And are the franchisees still under the margin pressure?
Franchisee margin, because of their sales reducing, they have some margin pressure. But we are trying to increase their secondary sale so that their margin pressure is sorted out. And also they are, like us, reducing the cost. They are also in the efforts to reduce their costs.
Got it. And now that the franchisee share is 76% of the network, so what is the ROCE difference between the cocoa and the franchisee model?
Can you get it back?
So as we saw that the franchisee share is up to now the 76%. So what can be the ROCE difference? Sorry, sir?
Store count. You are talking about store count is 76%. Not
Sales we have
percentage of network.
Store count. That means
Yeah.
Store count, but in our sales, 60% still comes from our cocoa. So where the margin is compared to the franchise. Because franchisee, there are two types of franchisee. One is the EBO franchisee where we sell the product, where there is also commission-based franchisee, where the stock is in our books, we give them commission.
Got it,
where the
sir.
margin is slightly lower compared to cocoa and EBO.
Got it, sir. And as we saw that the store count has been reduced from 893 stores in Q2 FY26 to 864 stores. So what is the total number of the stores in the cocoa model in FY26?
Around 195 is COCO and balance is franchise.
Got it. And what will be the average store level EBITDA loss of those closed stores?
Yeah, store closed is around there are around ranging from 5 lakhs to 25 lakhs in a year.
EBITDA loss per year.
Yes, EBITDA loss.
Okay. And so my last question was with regards to the future prospect. So are we moving towards a largely asset-light model over the next 3 to 5 years?
Yes, obviously, asset-light model things will expand more through franchisee. And in case of COCO, we'll only open where there is a strategic point and there is profitability.
Got it, sir. That was all from my side. All the best for the future. Thank you.
Thank you.
Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one. The next question is on the line of Prateek Shah from Investing Alpha. Please go ahead.
Hello. Hi, sir.
Hello.
I hope I'm audible.
Yes.
Yes.
Yes. So my first question is, so East India remains our strongest region. So the expansions in the South and West, are they delivering better growth than the core East region? What is the comparison there?
Still, East India is giving a better growth than South and West. West, we are not opening new store now. We are opening franchising East and some parts of South. So our concentration for the next 2-3 years will remain in East and South.
Okay. Any divergence in demand between metro city or this tier 2 or 3 markets?
Franchisees are doing a little bit slightly better than the COCOs. So COCOs are mainly in tier 1 type metro type of markets, and franchisees are in little smaller markets than that. So that trend we can say is there.
Okay. And another question was on the P&L side, like the 9 months of gross margins have declined to 48.2% versus 53.1% last year. So how much of this decline is structural or just in temporary basis?
So see, the gross margin for the first 2 quarters declined because, as we told, we sold lots of in the USSS and continued the ES for 6 months. And also there was, we have taken a price cut in the last year. We have reduced the prices. We have also reduced prices during the GST cut. So more or less, we have seen around 20-25% of the sales are discounted sales where the margin impacted, and also around 3 to 4% has been because of the price cut. So both these taken together has made the decline in the gross margin. However, in third quarter, the gross margin improved compared to first 2 quarters.
Right. And so, what will be the normalized, steady state gross margins for FY27?
I think around 49-50% will be the steady state of gross margin in FY27.
Okay, got it. And EBITDA margin is now about 13%, and it was 15 or more than 15% earlier years. So post pricing reset, and GST benefit pass through, what is the realistic EBITDA margin band over to the coming years, like 2 years in the period?
See, the EBITDA margin declined because of the decline in sales. Okay, means we have tried to reduce the cost, but the reduction of sales is more compared to the reduction of cost. However, I think based on the cost structure and the sales and the margin for the next year, we can expect in FY27 around 14 to 14.5% EBITDA.
Okay. And one last question. Can premium brands lift blended margins meaningfully?
Yes, we have seen the margins in British Walker and Sharon is higher. And if the composition of sales shifts towards the premium brand, obviously the margin will improve.
All right, sir. That was really helpful. That's it from my side. Thank you.
Thank
Thank
you.
you. The next question is from the line of Devanshu Bansal from MK Global. Please proceed.
Hi, sir. Thanks for the opportunity. So you have captured what I'm going to ask in previous questions. So, but as a management, there has been a big demerger that has happened, right, in our company. If you could lay down your strategy for the demerged entity Khadim in terms of growth, margin, balance sheet, that would be really helpful for us to appreciate and track your performance, right? So, but here, maybe from a 3-year, 5-year outlook perspective, as in how you are trying to expand the network in terms of products, what are your key focus areas in terms of gross margin, etc., EBITDA margin, etc., then it will give us a better picture as in how to track your performance. So tidbit queries, clarifications, etc., though are really helpful, but if you could lay down from a strategic thought process perspective, how are you shaping the next 3 to 5 years for Khadim, will be really helpful. Maybe if you would like to answer now or through a detailed PPT, that's up to you. But I guess I thought I'll just make this case in this call to get a better clarity on next 3 to 5 years.
See, I can give you a brief answer to this question. As I already told, that means we have already closed around 65 stores. So now it has reached to a level where now we are trying to fix the same number of stores, and for the last 3 years we have seen a decline in our sales. So what we are trying to reach in FY27 is that there is no dip in the sales. We remain at the same sales because we have reduced the cost and we are further trying to reduce the cost. So our main objective is to keep the sales, at least the volume, there is no volume degrowth, and with the price, if there is an increase in the ASP, there might be some growth in our sales. And we will try to make a margin, as I've told you, our gross margin of around 49 to 50%, and we'll try for a EBITDA margin of around 14 to 14.5% in FY27. So FY27 will be a benchmark year where we'll caliber everything and try to improve from that part. So what we have done, we have corrected our inventory, we have taken call on our stores, we have closed the store which are bleeding, so we have changed our product profile, we have now implemented British Walker, Sharon, premium brands to bring in some margin. We are concentrating on e-commerce so that some part of the lost sale comes from e-commerce. We are trying for some institutional sales from there also generate margin. So what we have seen, if we are able to generate sales, our margin in EBITDA level will improve and we will definitely give a good result. And based on that, we are preparing our budget for this year. I can give you a detailed analysis of that in future mail, or I can share you with our PPT. So you better give a mail to our IR consultant. We'll provide you with the detailed data.
Sure, sir. And just what I could gather is from a top line perspective, FY27 should be more like a 350 crore kind of a top line with 14.5% EBITDA margin. And then that EBITDA margin, what is the PAT that you are anticipating, sir? PAT margin at 14% PAT margin, should it be like 2% or how?
Around 2.5%.
2 to 2.5%. Okay. And on the balance sheet front, sir, as in how much are you planning to invest, or maybe that optimization that we have done in FY26, would it continue in FY27?
So we will keep the inventory we have already optimized. Now we are taking up the data's optimization. So I think some improvement in working capital will come from the data's end. Some money has been stuck in our institutional. We will try to generate that money. Once that money comes, our working capital will be sorted out. And also through good sales and EBITDA margin, means total efficiency of the business will be improved.
Sure, sir. And out of total stores, which are 864, you said about 200 stores are COCO. And for the rest 660 stores, there are stores where in some component the stock is with us. So what is that number, as in for how many franchisee stores the stock is with us?
Say around 70 stores.
Okay, so broadly for 270 stores, ballpark, the stock is with us. For rest all it is with franchisees, right?
Yes.
Okay. Okay. Great, sir. Just, I'm sorry I'm repeating this, but if you could lay down your next 3 to 5 year growth and margin roadmap in your next PPT, that would be really helpful in terms of tracking your performance, and as a good corporate practice as well, which will be really appreciated. Thank you so much.
Okay. Okay, Devanshu.
Thank you. The next question is from the line of Ankit Shah, an individual investor. Please proceed.
Yeah, hi. So you mentioned that the inventory is reduced to 117 days, and which you are looking to further reduce to 105 days. So, in absolute amount, what would this be? And also, if you could give similar number for the debtors also, what has been the reduction?
Now the inventory is around 123 crores compared to 145 crores previous quarters. So definitely we'll try to reduce it to 110 to 115 crores. And in debtors, we have, as you told, in third quarter there is no improvement in debtors, but from the fourth quarter we will try to reduce the debtor to the extent possible, and in FY27 we'll try to reduce the debtor to a normalized level.
So within this debtors, only say 20-25 crores is Punjab. The rest is all your franchisees, right?
Franchisee and yes, it's franchisee. 32 crores is from Punjab. Balance means once the Punjab payment comes, then debtor days will reduce drastically.
Okay. But so basically, if I look at your current run rate, it's around, say, 380-400 crores. Of that, 40% is, say, roughly, say, 150 crores is your franchisee revenues. Okay. And so, so we are actually carrying debtors which are more than 1 year of our revenues.
No, because this is mainly because the debtors there is institutional debtors, so that has increased where there is no sales. So, but you see, it's more than 6 months, and it's more than 6 months debtors is there. So that's what the reason we have taken one. We are taking one at a time. We have done inventory. Now we are focusing on the debtors. So hopefully the debtors days we'll try to reduce it to 120 days.
No, how much is institutional debtors out of this 198?
It's around 35, 36. 160 would be the franchisee debt.
So your franchise revenue is 150, so you're actually carrying 1 year of debtors on franchise.
Yes. But still we'll try to improve, because we have taken the call on the primary sales. That sale has been reduced, and the debtors, the payment cycle is slow. So for that reason, we are getting less sales, but still we are trying to improve the debtors days. Once the cycle improves, the debtors days will also improve.
Okay. And just one more question. I saw your website is completely revamped, which is a much better experience than earlier. In So now what is our, if you can help, what is our online percentage of, say, out of this like, say, current run rate? If you were to say, what is the, like, how much are we doing on online? And secondly, what is the margin, net margin after logistics and, the marketplace commission? What is the margins that we make on online?
See, we around 3 to 4% of the sales comes from online. In online, there are two types of sale. One is the sale from our own website and the omni sales from the retail. So there the margin is around 10%, and whereas in the marketplace, the margin is 1 to 2%. So what we have done, we have shifted the total the online operation to third party with e-cart. So we are trying to reduce the cost so that we generate more profit from the online. Next year, we have a target of increasing the online sales to 10%. Out of that, maximum sale will come from the khadims.com and britishwalker.com, which is our own website. We are also in a plan of launching the sportshoepro.com, and we are increasing our marketing costs on there so that we can generate more revenue from there and get more margin.
Yeah, we are doing a lot of focus in our own websites now, which previously we didn't do much. So we are putting a lot of focus in our own website, khadims.com, britishwalker.com. Some other websites also can come up. So we are going to have a very deep penetration through our own websites.
Understood. And so e-cart is basically Flipkart, right?
Yeah, that's Flipkart,
Amazon,
all those places.
No. E-cart is owned by Flipkart, right?
Yes.
Yeah, it's owned by Flipkart, but they keep the stock for
the marketplace.
All the marketplaces.
So basically, our own website is managed by us, including marketing, shipping, everything. And only the third-party marketplace is managed by Flipkart.
Yes.
Yeah.
But actually, see, Myntra, which is the biggest fashion platform today in India, on that we don't have any presence at all. And that is owned by Flipkart, so I don't understand.
We have some presence on. Hello.
Yeah.
Yeah, we have. It's not right that we don't have any presence in Myntra. We have got some presence on Myntra. But, like for online also, we are developing new products so that, we can have a profitable sale from these marketplaces also.
Because what we have seen
is by selling too much also in these platforms, what you end up doing is incurring losses. That's why we are focusing a lot on our own website. And what we are doing is we are developing exclusive lines so that we can, which are more premium looking, or like we are trying to develop lines which would be profitable in marketplaces also. So that exercise we have just started. So once we are able to provide products in that, we hope that in these marketplaces also we can have a meaningful profitable sale. Until then, we are giving a lot of focus on our own websites and omni sales. And most of all our own website stocks get serviced from our stores. So, the shipping cost also reduces because your whatever order is coming from Bangalore will get serviced from the Bangalore stores, or whatever comes from Calcutta will get serviced from the Calcutta stores. So that sort of a ecosystem we have trying to do.
Yeah. And look, you mentioned about West and that, in West you are defocusing. So just a thought that, maybe for West you can move completely online, and whatever, franchisee and stores you have, there's no point, now continuing if you're anyway defocusing. So why not shut the entire West region, because it will release a lot of capital also.
No, there are some franchisees who are doing good business. They don't want to stop. But yes, we have some states like Rajasthan, we have come out. In Gujarat, there are some good stores that we have, but that we don't want to stop now because they are profitable and EBITDA is also positive.
Understood. And just one last question on franchisee sales, whatever we are billing. primary sales, whatever we are billing, what is our margin on that?
We generate a margin of around 42% on the primary sales.
Okay. Understood. Thank you. That's it from my side.
Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. The next question is from the line of Anupam Jain from Indra Securities. Please go ahead.
Sir, you mentioned that Skechers do a 1.5 to 2 crore. Is that a per month, for every month, or was that for year?
This is for this financial year.
Okay. That's very small. And how many athleisure inventory do you carry? You're rolling out athleisure inventory because you're rolling out athleisure.
Yeah, athleisure, we have got around 40-50 designs, and inventory would be around, say, like 50 lakhs.
Okay. So, are you planning for an aggressive rollout for this, or how many stores are in this athleisure inventory currently?
70 stores.
70 stores. So, you have 45 SKUs and inventory that you're carrying is 50 lakh.
Yes.
Okay. Any aggressive plan up to scale this up?
That depends. We are in a.
See, the main thing about our athleisure is our pricing is very good. Okay, it's a very, what do you call that? Competitively priced product. So what we have seen is during the winter season, the athleisure sales drops a bit. This is our first year. Okay, so but again the summers and all are coming, so we hope that the sales will increase again. And in athleisure, it's mainly like every time you order something, you have to order new designs. Okay, it's your old designs. The apparel industry works like that the old designs are not always available once you finish some of them would be available, but not all of them. So we'll be taking it in batches, like every quarter we'll take some new designs and display and see how it goes.
But what is your store pricing? Store rollout is you're less than 10% in your stores currently in athleisure. What I'm trying to say is, what is your target to get at least 50-60% in your store in athleisure? Because your sales are dropping, one thing that you're trying to do is increase it in online e-commerce.
See, what happens in athleisure is that if you compare to our stores, there are stores which are very small, where we cannot put up the athleisure thing. So that is also a hindrance for us, because we don't have a changing room. For ladies, the athleisure, we cannot give a changing room. So these are the factors that are taken into consideration. After that, we are planning out to roll the athleisure in our store.
But do you have any target that we can track this?
No, we will definitely increase the athleisure sales, but we will not go whole hog, because there are lots of stores where we do not have the space to put in athleisure, and there are some problem in changing room also. We don't have any changing room. So because in athleisure you require the changing room.
So will it be 50%? Will it be 30%?
I think in our COCO will definitely go ahead, but in franchisee, it depends on the franchisee whether they want to take the athleisure, because out of the 660 franchisee, 50-60% of the store is around 400 square feet, 300 square feet. So where athleisure will not be possible.
Okay. Secondly, you said when you were giving guidance that you want to do again, you are looking for institutional sales.
Institutional, not government institutional. It's institutional in the form of school institutional safety shoe, where to the private companies.
Yeah. Okay. Yeah. That because I was confused because we are already stuck with the Punjab government and we are again looking for institutional sales.
No government institution. We have stopped for the last 5 years.
Yeah, that's what your intention was changed. Okay. Thank you for clarification.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to Mr. Omkar Bagwe for closing comments. Over to you, sir.
Thank you for joining us on call today. I would like to thank the management for sparing the time and answering all the queries. We are MUFG in time, Investor Relation Advisors for Khadim India Limited. For any queries, please feel free to contact us. Thank you everyone and have a great day.
Thank you.
Thank you. On behalf of Khadim India Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.